In this video, we'll discuss material errors, fraud, and illegal acts in financial statements and the responsibilities of auditors in these situations. Material errors are unintentional mistakes in financial statements due to data gathering errors, misinterpretation of facts, or misapplication of accounting standards. The emphasis is on unintentional mistakes. Auditors are responsible for detecting and reporting material errors to the audit committee. But what makes an error a material error? A material error means false or misleading information that could reasonably affect a decision to extend or deny credit to the buyer. The Supreme Court stated that an error is material if there is a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. Accountants and auditors often use a measure such as 1% of revenue as the initial measure of whether an error is material. However, many other factors could also impact that decision. Accounting fraud is different than a material error and refers to deliberate and deceptive practices in an organization's financial reporting system with the intent of presenting false or misleading financial information to stakeholders, including investors, regulators, and the public. The intent of management determines whether the misstatement is an error in judgment or a deliberate decision to manipulate earnings. In a court of law, it typically comes down to the credibility of the CFO and CEO who are charged with fraud. Fraud, whether fraudulent financial reporting or misappropriation of assets, involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. Accounting fraud not only misleads investors and stakeholders, but it also undermines the integrity of financial markets, damages investor trust, and can have severe legal and financial consequences for both individuals and the organization involved. Detecting and preventing accounting fraud is crucial for maintaining transparency, trust, and the accuracy of financial reporting. This responsibility falls on auditors, regulatory bodies, and the company's internal control systems. Accounting fraud often involves misrepresenting financial data to meet specific financial targets, boost stock prices, secure loans or investments, or hide financial difficulties. It can take various forms, including revenue recognition fraud, which involves falsely recognizing revenue before it's earned, such as recording sales that haven't occurred or inflating the value of sales. Expense manipulation includes understating expenses or delaying expense recognition to overstate profits. Asset overvaluation happens when the company inflates the value of company assets like inventory or property to present a healthier financial position. Liability underreporting happens when the company understates liabilities such as debt or outstanding obligations to appear less risky to investors, whereas off-balance sheet transactions includes keeping certain liabilities off the company's balance sheet to make the financials look better than they are. Improper reserves and accruals involves manipulating the amount of reserves and accruals to create false financial stability. Channel stuffing in the process of forcing distributors or customers to take on excess inventory to artificially inflate sales figures before the end of a financial period. Although the customers and distributors will likely return the product, It won't happen until after the financial statements have been issued. Misclassification of expenses happens when regular operating expenses are classified as capital expenditures to delay expense recognition. Fake transactions includes creating fictitious transactions or companies to fabricate revenues, expenses, or assets. Illegal acts in accounting typically include actions that violate laws, regulations, or other legal requirements. They could take the form of financial fraud, bribery, and embezzlement, as well as violations of specific industry regulations, environmental laws, tax laws, and more. Illegal acts have significant consequences aside from financial penalties and legal action. They can result in severe damage to the company's reputation. In these situations, it is the auditor's responsibility to detect and report misstatements resulting from illegal acts that have a direct and material effect on the determination of financial statement amounts. Auditors should also detect other legal violations. However, their primary responsibility is related to the financial statements. Auditors also must determine the proper accounting and financial reporting treatment of a violation and should consult with legal counsel and specialists as needed. The auditor should also report illegal acts to those charged with governance, such as the audit committee. And if the client does not take the remedial action deemed necessary by the auditor, then the auditor should withdraw from the engagement. This action on the part of the auditor makes clear that they will not be associated in any way with legal activities. The Private Security Litigation Reform Act, PSLRA, of 1995 places additional requirements upon public companies registered with the SEC and their auditors when 1, the illegal act has a material effect on the financial statements, 2, senior management and the board of directors have not taken appropriate remedial action, and 3, the failure to take remedial action is reasonably expected to warrant departure from a standard, meaning unmodified audit report, or to warrant resignation. Once the auditor reports to the board that remedial action has not been taken to correct the detected illegal act, the client has 1 business day to inform the SEC under the requirements of Section 10AB of the Securities Exchange Act of 1934, required responses to audit discoveries. The board should provide the auditor with a copy of the notice provided to the SEC. If, however, the client fails to report such conduct to the SEC, or the auditor fails to receive a copy of the board's notice to the SEC, then the reporting obligation falls to the auditor, who must then resign from the engagement or furnish the SEC with a copy of the audit report the following day. If the auditor resigns, they must still provide the SEC with a copy of the auditor's report within 1 day following the client's failure to do so. An example of these type of issues is the recent research report of the Hindenburg Company about Supermicro, in which Hindenburg claims that Supermicro is engaging in accounting manipulations, has undisclosed related party transactions, and is evading Russia sanctions through Turkish shell companies. In its report, Hindenburg states over a 3-month investigation, which included interviews with former senior employees and industry experts, as well as a review of litigation records, international corporate and customs records, found glaring accounting red flags, evidence of undisclosed related party transactions, sanctions, and export control failures, and customer issues. And this is not the first time Supermicro has had issues. In 2018, Supermicro was temporarily delisted from NASDAQ for failing to file financial statements. By August 2020, the company was charged by the SEC for widespread accounting violations, mainly related to $200 million in improperly recognized revenue and understated expenses, resulting in artificially elevated sales, earnings, and profit margins. Less than 3 months after paying a $17.5 million SEC settlement, Supermicro began rehiring top executives that were directly involved in the accounting scandal per litigation records and interviews with former employees. Supermicro's stock decreased by over 25% since the publishing of the Hindenburg report.